Jinesh Gopani joins us. Let's take a conversation forward with him. Jinesh, what looked like a perfect start for the year, global cues were strong and supportive, flows were back, we were warming up to a good earnings season. Suddenly things are looking shaky. Nasdaq is down, crude is up, volatility is back, FI selling is intense. Are we in a sticky spot now? Are we in a spot of bother? Do you think bad could get worse?
Yeah, hi. It all depends on how the inflation and the US yield moves. You would have seen there has been sudden spike in US yield from 1.5, 1.6 to going all the way to 1.8 something. So obviously there is some jittery around passive flows. I would say in a big in a way that normally it's more of a sort of a I would say non-active money, and which leads to a lot of volatility in the market. And clearly that is also seen across the globe, where more of the passives, the ETF kind of money is leading to this sell-off. So the flow-based rally which was there, I think seems to be stopping for now. And all will depend on how the inflation is getting under control and how US yields react from here on.
So if let's say yields go higher to 2.5% to 2.25%, what happens to market then? And what if yields don't go higher? So construct both the scenarios for us.
So I think if it all depends how yields move higher. So if it is moving higher very quickly, then obviously you are in for a trouble. There could be a larger sell-off which can come. And on the flip side, if yields now stabilizes at this level and trending down, or if the inflation trends down over a period over next 2 to 3 month period, then I think market will find some stabilization at some levels, and you will have again flows coming back. So, Nikunj, very difficult to take the flow calls because large part of the flow calls is passive, which is, I would say, it's sort of a dumb money which comes and goes without any fundamentals.
So what's the prudent strategy right now, Jinesh? I mean, stay invested, the long term and the medium term picture does not change, or it's time to start reassessing both risk and valuations. For example, we've seen a sharp reversal in US technology stocks. We've seen a very sharpish kind of a reversal in global mid cap stocks. Should we be cognizant of a very different scenario in 2022?
Correct. Nikunj, if you really dissect the mid cap, small cap, and large cap, you will see a very differential view in terms of how the flows are keeping the stocks up or down. So, if you really see mid cap and small cap, where more large domestic flows are there, markets are holding on, stocks are holding on, even if they are at, let's say, 40, 50, or 60 PE. And that is thanks to the flows which are coming again in that segment. Whereas on the large cap side, if you really analyze Nifty, the large part of this sell flow is because of the foreign institution, which are large shareholders in the Nifty stock. So clearly, there is a significant divergence in terms of how the flows are deciding the markets. Having said that, I think clearly the focus should be on the companies bottom up who have a resilient earnings growth profile and are able to surprise the market from here on. The Me Too companies will find it difficult given the inflation where it is, and ability of the business model to pass on cost to the end consumer or to the end client. So clearly, bottom up stock picking, as we always have been saying, that companies which are able to pass on the cost structures and are able to navigate these difficult phases of this inflationary environment, I think that is where you should put your money.
Hi, good morning. So, Dinesh, when you talk about surprising the street, we're still waiting for those kind of earnings to come in, and a space which had really, really run up and where people made a lot of money last year was, of course, the mid-tier IT companies, right? But now if you look at the kind of numbers that have come in from Ascient to even a Persistent Systems, yes, good numbers, but in line with estimates and not surprising the streets. how to approach a space like that where there's also talk of valuation run up and if there's a time for PE compression?
Yeah, so as I said, unless you surprise from here on, you cannot justify valuation because already you have started discounting 23, in some case 24, even the new IPOs which are coming, you have started justifying on 24, 25 numbers. So unless the near term surprise in terms of earnings growth doesn't come by, or the other metrics doesn't come by, I think it is going to be difficult for those companies to sustain those valuation. So it is going to be tricky. Not all 2,000 companies which are listed, 2,000 companies or more which are listed are going to give you those surprises. So you have to be razor sharp in terms of what you want to own with a longer period of time. Whether you are looking at Me Too companies, then you are looking for trouble. If you are into leadership kind of companies, hopefully they should pass this phase much in a much better manner.
And by just seeing your portfolio, right, if I look at the top 5 sectors, financials have a 30% plus weightage, IT has a 16% weightage. With this, and you're just continuing from what Nikunj was also asking, if you're going to see the kind of tech sell-off that you have on Wall Street, where literally €1 gains is being wiped out in a matter of 3 weeks, is it time to, bring down exposure when it comes to IT? Is it perhaps time to increase it when it comes to banks, or play with the profit cycle and the revival of the capex with industrials and manufacturing stocks?
See, I think it is a tough call at this juncture because if you really see, even the domestic economy will be under pressure because of higher oil prices, higher inflationary scenario. And so, to answer your question, whether IT is better than banks or IT is better than industrial, tough to say at this juncture because both sides you are facing the conundrum of inflationary scenario and the flows which are not in your favor. I would say from a long-term trajectory, 2-3 year trajectory, we still like technology as a space. Obviously, some correction is good, which should keep the stocks healthy, and there should be resurgence in buying at some point of time. So obviously, as I said, all technology stocks might not do well, but we see a lot of momentum on the business side. And if you would have heard some of the conference calls, I think it is not a 1 quarter or 2 quarter kind of a growth they are talking about. Clearly, there is a runway of growth. And so long they are able to deliver it, I don't think there is a need to exit those stories completely. Obviously, you can trim down from your portfolio and move into banks or something else which have not participated in this rally in a big way. So obviously, as things improve on the banking side, we will see flows coming back. But again, as I said, we'll have to be very very razor sharp in terms of how to analyze how the economy is moving with higher oil prices, higher inflation, and whether that really calls for big shift.
Jinesh, I want to talk about one theme from within the consumption space. I know we loosely call it the reopen trade, but just the textile retail plays, for instance, your likes of Trent as well as Aditya Birla Fashions. Just wanted to understand how is it that you're supposed to look at these stories? Because if you take cognizance of their listed history, they've been multi-baggers in that sense, at least Trent has. And now of late, you've seen them get pretty aggressive with, these niche acquisitions, etc. as well. And they really seem to be on an expansion spree.
See, I think companies who have been able to survive the onslaught of slowdown or the economic lockdowns over last 2 year period, I would say, I think they will really rule the roost going forward. Having seen such a bad time and coming out of it without significant scratch and balance sheet remaining stronger and stronger, I think those companies will do well. We have to have faith on the economy. If economy is going to grow at 6 to 7% real GDP for, let's say, next 5, 7, 8 years, then I think all these would definitely show you good growth. The patience is the game now. The flow driven rally is over, and hence one has to be very, very cognizant about near term volatility versus long term visibility.
Sure. The other space also is, the pure play consumption theme, your likes of Asian Paints, Unilever, etc. While each of them are grappling with specific problems such as, the rural demand slowdown in the case of Unilever, they've still managed to post quite an okay growth number. Having said that, the raw material cost pressures once again are building up as a niggling worry. That for a high valuation sector such as FMCG as well as, paint segment for instance. Jinesh, is the time to get a little bit cautious here?
Yeah, see, I think if economy doesn't suppose the passing of the cost, then I think there is going to be a challenge in terms of generating volume growth. So we really need a good economic growth, which should support the inflationary pressures. And if demand remains strong because of the good economic growth, then I think you can pass it on, let's say 75% of your cost inflation, and rest you can manage it through your internal efficiencies. But if the demand itself gets disrupted or disturbed because of this higher inflationary scenario, then I think there is going to be a challenge. So as of now, at least the commentaries of the companies, if you really see, they don't seem to be very worried on the demand side. In fact, they are looking at good FY23 and 24 in terms of economy and hopefully the sector where they are. So I think no need to be significantly worried on that front, because all these good, great companies are able to pass on their cost over a period of time. And that is what we have seen, despite, let's say, 25 to 28% rise in inflationary pressures in cost, they've been able to pass on 18 to 22%. So, which is a very significant, I would say, push they have done in the cost inflationary scenario. And despite that, they have been able to demonstrate volume growth. That speaks about the leadership quality of the company and the ability to sustain this kind of shocks. So I think near term, let's wait for 1 or 2 months. Let's see how economy is chugging along, and if there is a momentum continuing despite high oil prices, then I think we should not be that worried. Having said that, near term, as I said, is going to be a bit tricky.
रैप करो उसको यार.
That's the take coming in on the markets right now. But Jinesh, great to have you in the show. Good to speak with you as always. Thank you so much for taking the time out.
Pleasure. Thank you. Stay safe. Bye.